Good afternoon, ladies and gentlemen. My name is Ryan Suter. I'm one of the senior investment managers here at Sharewise, and we're here with Dennison Hambling, the Managing Director of Intelligent Monitoring Group. Now, Dennison's been kind enough to lend us his time this afternoon, along with give us a brief presentation of Intelligent before he is going to open the floor to questions. Now, I've got a couple of questions after the presentation that I will start us off with. But if any of the participants would like to submit further questions for me to ask Dennison, please do so using the Q&A function on Zoom. But Dennison, it's all yours. Thank you very much again for your time.
Brilliant. Thanks, Ryan. Just checking you can see that screen with the presentation on it.
Sure can.
Okay, brilliant. I'll rip into it, guys. I'll try and move through fairly quick today so we can get to some questions, but usual stuff here. So just, I guess, for those that aren't privy or aren't up to the play with what we are, IMG is the leading provider of security and security-related services and solutions in Australia. We are the #1 monitoring security partner in Australia, probably equal to our nearest competitor in monitoring. What does that mean? We look after about 210,000 businesses, homes, and people across Australasia. One of the benefits of our business, and particularly in that operations, that monitoring piece, is it makes our business very stable. We have a very stable, secure, recurring revenue stream of about just over $6 million per month. In terms of scope and size, what does that mean? It's about 530 full-time workers across Australasia, a fairly balanced workforce. Security is a product for a service for everybody. It affects everybody. Share market value of around 150, just over 150 million, with a major shareholder who has been slowly, I guess, diluted as we've gone through this journey of Black Crane. Peter and I have known each other for a long time, and he has been a feature of the story, which we'll talk to shortly. To give you a scope and really the key value behind part of our business is we stretch from Cape York to Stewart Island in New Zealand now, and that's been a really important part of what we've needed to do and what we're looking to do in order to give ourselves a point of differentiation as the leading provider as we look to step into that leading provider position. Board, 5 people on the board. We're a very corporate and focused board. There's no slackers on this board. We've all had different experiences. We've at different times, some of us have crossed paths before. I guess the most important thing I'd point out, though, is we've recently, in the last month, welcomed Mark Brisson to our board. Mark priorly ran what would be our biggest competitor in Australasia, being Chubb, for about a decade. He is retired. He's now serves on boards of security companies around the world. He is not an Australian citizen. He's a Canadian originally with a wife from Spain who lives in Hong Kong. So Mark's a very seasoned global player. And I think seeing someone like that join our board should be, it should be an indication for people about the kind of quality to look to what we are building and what we're looking to do. Structurally, IMG, what is it? Effectively, we have 4 principal business areas. Quite simply, so commercial security, residential security. Now, obviously, with the ADT name, people associate us as a residential security play. Interestingly, 60% of our business today is actually commercial. We have a medical and a care business, which is still a little bit, I guess, quiet inside of the business in terms of the way we present it, and a wholesale monitoring service where we provide monitoring for about 40% of the security service players in Australia's businesses. So you may have a local security provider who may put alarms and systems into your house that is monitored back to base, or a business, more probably likely. There's a good chance that we are actually the party at the end of that service monitoring those lines. And we operate under 4 business units. One's really easy. ADT New Zealand is standalone. It does the full gamut of security services. In Australia, we really have 3 points of presence. ADT, which is really more increasingly around commercial and enterprise security. We have Signature Security, which is a really focus more on the Resi and SME market, and is a long-standing name in Australia that we've brought back to life recently. And IMG Connect, or Intelligent Monitoring Group Services, which is our wholesale bureau business. So a clean structure with 4 clean areas. Very seasoned and experienced team, and a good mix between long-standing industry experience, some good general business experience, and then some, relatively more recent youth and experience in terms of having built successful businesses themselves and now leveraging that into us. So we've got a really good balanced team of people who know their way around this industry really well. Effectively, these are my direct reports as MD to the business. In terms of the company timeline, you're joining this call at a particular point in time, but if we look backwards in time, the story's really been 3 steps. First step was sort of Peter Kennan and my joining the board, and that was it was a reverse takeover type company back about 2016. Rolled up a couple of businesses and was going along quite nicely, and then rolled up one big business that turned out with a lot of debt, that turned out to be a poor performer, which led it astray. Second phase was 2020 onwards. Peter and I joined the board. We rolled up our sleeves. We've invested in the business. We've put new technology platforms into the business, and we've got it moving from losing cash flow to making cash flow, really through to this phase that we're in now, where for us 3 odd years into this journey, we're seasoned, and the whole team is. And I should make the point when I talk about we, again, just to reiterate, this is a 533 person business, and Peter and I are only 1 or 2 of those people. There are a lot of people that make this business the business that it is and becoming today. But we're in a position now where we're optimizing and looking to grow, which is an exciting place to be. So what are we trying to do? What is the point, the opportunity, and I suppose you'd call it the dream for this business? Or we see that there is no clear leader in security services in Australasia. Whilst most industries I've experienced, or we see, all of us collectively, typically, we're in an era of increased consolidation. That hasn't happened in security services for a number of reasons, and we see a clear opportunity for that. So we don't make any bones about this. Our mission is to become that leader. We're not looking to be number 2 or number 3, but we're also looking to do that, more importantly, through the quality of the work we do and the recognition that we gain. So scale of itself is meaningless if you're doing a poor job. We are looking to build a really, really high quality business with a high quality group of people. And so for us, it's about leadership in the couple of key market areas that we have, and that's the opportunity that we see is in front of us. To do that, particularly to grow, there's really 3 clear areas to which we are focused on, and they have different timescales. They have somewhat different sizes in terms of opportunity, but they are quite clear. The first one is the commercial security market, and commercial here is really larger scale businesses. For us, it's really enterprise scale businesses, so BHP, Anglo, names like that, businesses of that scale. They are looking, or we are able to use technology solutions available today to improve their businesses, whether that's safety, reporting, or even productivity. And so what they are looking for, though, is a national single counterparty, and that hasn't really existed from a focus player for some time. Second one is residential. We see a structural opportunity to lead that market with much better value, much more current technology mix than has been in this market for a long time. And we don't really see anybody else doing that of scale, and certainly no one else with a presence or a name like an ADT. And then the final one is actually the care market, a market that's growing today at 8% per annum, which is effectively all of us when we get through to retirement and start to wonder, what are we going to do? Are we going to stay in our house? Are we going to go and find somewhere to live, to be looked after so that we're okay? We serve that market with alarm and alert systems, which is also a changing market from a technology point of view. So 3 very clear: commercial, residential, and care markets, all of which I say very loosely, but sort of to give you an indication, each one of those has the ability to double the size of our business today. The first one's commercial. we can double our business. We think we can double that business from residential over time, and we think that whole business can be doubled again through the care opportunity. So a number of really scale opportunities. They do have different timestamps though, and our ability to influence that growth to build it and to compound it is different in each market, which we can come back to. So to be a bit more clear about, I guess, enumerating those opportunities, commercial and enterprise today, our first goal, and what is we see as a $5 billion Aussie dollars market in Australasia, is to get back to where the ADT business used to be. Now, it fell from that perch as an active decision by its prior owner to get out of that market, not because the market was poor, but because they made a global decision from another country around sharing that work differently in their portfolio, which ultimately failed. We're focused on taking the ADT name back to where it was in commercial security, which implies about $130 million revenue business today, and we're at 40 million today. We've got to 40 million today from a $2 million base that we had when we bought the business in August last year, through to about 12 million at the end of this year, organically run rate, through to the acquisitions that we've just made, which will go on top of that to get us back to some scale. As part of that journey, and it's not particularly meaningful, but I use this to indicate the distance that this business has come in the last 3 years. 3 years ago, I went to there's one conference for this industry really in Australasia of scale and meaningfulness, and that's essentially what we call the ASIAL conference in August, September each year. The first year I went to that, I guess as an executive director of IMG, we were irrelevant, and I walked around and realized how big this industry actually is. I went, wow, okay, this is actually a much bigger industry than I realized. A lot more people doing a lot more work, and we're a nothing, even though at that point we were the largest independent monitoring company in the market. Second year, I went back. We had just bought ADT, so this is last year. And having been, exactly precisely nobody to anybody in that first year, this year we went back with the ADT badge on our shirts, and suddenly people were really interested in us, like, wow, that ADT name, and I realized, geez, ADT is really remembered and remembered highly. It had been a key part of this industry for a long period of time until it had really stood back. This year, we're actually the principal sponsor of the whole conference. And so to me, that sort of shows the extent of the journey and speed and scope to which we've been able to come in and put this business into an increasingly notable position, I guess, at this point. The residential business is quite a simple situation. Again, just to put some numbers, I've talked in various places around the fact that whilst people think of ADT as a residential business, the reality is it isn't the biggest part of our business, is the first point. And the second point is this market for residential security in Australasia is the same size it was 5 years ago, 10 years ago, and 15 years ago. It's largely a stagnant market. And the reason for that, where the rest of the world has seen, 6 to 7 times size increase in market over that period of time, is because our products are being too expensive. We've been selling a commercial grade product to the residential market, which has made it unaffordable. With the advent of wireless technology and pre-programmable security systems, which are not, I should say, necessarily what a commercial security installer would want to put in as a piece of work, which is really why it hasn't happened. We have the opportunity to lift that penetration in this market now towards what is more common in the rest of the world. Hard for us to really understand that here, because security monitoring in your home is not that common, frankly, less than 5%. But in America, over 30% of houses pay monthly for monitored security. They used to be at the same sort of levels we are now 15 years ago. So new product set, new go-to-market. You need to see this product and experience before you'll believe me, and that will probably dictate the penetration and the speed of growth in that industry. So when people say, how fast can you grow there? I say, well, I know we can grow really big. I see no reason, I see no one else doing it. We've got the best brand in the market. I see no particular barriers, but I think customers are going to need to start to experience this before we'll see that sort of S-curve adoption that I think we can see and will see, like every other market has seen. And then the final one is that ADT care And the first step with ADT Care is just to go with market growth. We have a good little business today. It's much bigger in New Zealand than it is here. It's about a third of our business in New Zealand at ADT currently. In Australia, we're really just starting it up effectively. We had a base of business which had just been sitting in the back room unloved for a number of years, and we are getting that going now. And as part of that, I'm proud to say the guys, as of last week, have been become an accredited NDIS provider, which is part of the journey. But they also have been, for the first time in a decade, put back on the South Australian Government panel for medical alarms, which is a key. It's the most progressive state based system in Australia in terms of providing some subsidy to people in their houses to have medical alarms. And I'll segue for a sec. In that market, just so you're clear, my mum had a stroke 2 months ago in New Zealand. One of the reasons I can live in Australia, when she lives in New Zealand, I'm an Australian citizen, I should always like to add, is because she has an ADT alarm now. What does that mean? It means if she falls over, that alarm goes back to base and the alert will go off and people will try and track her down to make sure she's all right. If she doesn't respond, I will be notified, as will my family be notified, and they will action and a ambulance to go out to check on her, or people to go and check on her and see if she's okay. There's a key that is on the side of the house in a locker type system. That means that if somebody goes there and she can't get to the door, they can get into their home. So it provides me complete peace of mind that I know I can live here, because I know if something happens to mum in the short term, it'll get picked up, even if she doesn't herself trigger the alarm. If she falls over, it gets triggered. So you can see how that can make a meaningful difference. And if you've ever lived that journey, as we all will at different times, and increasingly it's very valuable. In that space, what we'll do though is take that simple alarming and monitoring technology of a very simple event, which is either somebody asking for help or having a fall. That technology is available to start to more actively track behavior. So get time out of bed, number of times going to the toilet a day, some key data that allows you to predict how somebody's actually going, and that market will become far more sophisticated with the technology available today, but will happen as that penetrates. And then finally, our wholesale business, we've done a lot of work on that business. We've got the most most modern platform to anybody in the market, but certainly the best platform of any of the larger players, that allows us to offer a lot higher value monitoring services. In particular, I'm really proud that we are, people will know Life 360 probably here. You'll know the tiering that they've brought into Australia around offering more active alarming services. So if your kids are on Life 360, anyone here, and they crash the car, or it looks like a car crash has happened, that will trigger an alert. They will be followed up if you're on the gold package. We offer that package. So we're Life 360's partner, and it's a partner there. And it's actually only because of us that they can offer that packaging in Australia. And it's a really good example for me of showing like what I mean when I said Australia has been behind. Everywhere else in the world Life 360 went, they had these services available. Yet in the Australian market, 3 years ago, they tried to find a monitoring partner to offer them equivalently to the rest of the world and couldn't, gave up in fact. And it was only a chance meeting I had in America with another control room who was looking after Life 360 that triggered a discussion to bring Life 360, back to the table, and now able to offer those services in Australia. So in a way, it sort of supports the points I make about the industry not having been at standard. So in terms of our business, I just like to take a pause because we're just through June 30, just to highlight how much and how far we've come. And I do that very carefully, actually. But before I say why we go through it, so, August last year, we acquired ADT. The first thing we did is we actually separated ADT Australia and New Zealand to be standalone independent entities. They were very meshed up with each other, and it was a bit like putting the All Blacks and the Wallabies into one team and hoping you're going to get a great team. Like, they needed to stand alone and compete and operate in their own market conditions. We've been transitioning off JCI systems, which was a key key piece of work, and it's one of the key reasons we got the price we did for ADT, was the amount of work and the risk for JCI around that meant they needed a trusted counterparty, not just anybody. And they were prepared to trade off a lot of money in our dollars to have somebody that could do that. And we've been doing that and are largely nearly done. There's only a real small tail bit of work to do, and in particular around the ERP system, where we've brought our own ERP system in. Refinanced our debt, raised equity twice, acquired actually 4 businesses, if you include Securely New Zealand, all bolted in, all part of our group today. And so whilst we announced today the acquisition of settlement of Alarm Assets Group in WA, that has been operating in our business now and is operating in our business today. It's people and contracts. The reason I hesitate because of the extent to which we've come through, and I should say, and we've met our guidance put forward, and in fact we upped that guidance a month or 2 back. The reason I hesitate just talking about that quantum is that it raises the question, which I'm most aware of any question looking at us, is, is there an indigestion to be had here? And the one thing I can say is, I come from a financial markets background. I've been directly invested in lots of businesses through my time, and I've seen that story. In my role, for me, failure will be indigestion. And so we're moving at the pace we can move. It is fast, but we're not moving faster than that, and we won't. We're building a platform for the long term and a business that can sustain itself for the long term. So we only move at the speed we can, but we're very focused. So we have come a long way quickly, but we have the best business today that we've had at any stage of that journey, and we won't move on to other things until such time as we are actually happy we can handle it. So quickly, I'll spin through these because they're all public, but we put these numbers out when we did the acquisition of and the capital raise most recently for ACG and AAG. Effectively, we're a $39 million EBITDA type business today. So, north of 150 mil of revenue. I guess notably margins at around 25% EBITDA margins. People ask me, what do I think happens to margin? I think there's the opportunity to creep those margins up over time, but it's not something we're desperately urgent to do. We're very keen to reinvest in the opportunity set here. We're very keen to deliver a good level of growing profitability with good returns for investors and shareholders. But as we scale and grow, there is the opportunity probably to push that towards 30%, which would probably be globally leading margins, but we'll do that carefully over time. The notable thing that we still have to do now is to refinance our debt from an expensive facility. I pause here always just to say the reason it's expensive is because when we bought ADT, we had to have cash certainty, and I wasn't allowed to take the deal to the equity market and go and put the hat around. So to do that, I had to lean on existing shareholders at the time, the senior large existing shareholders, of which Black Crane was the key one. And we had to go to the debt market and take what we got for funding costs. We bought ADT for $44 million. I think the closing statement was less actually. And it was at the start of the deal, a $200 million deal. So I always say, whilst that debt costs, anybody that sort of puts their nose up and says, well, you're paying a lot for debt, I say, yeah, but we paid a lot less for ADT than we would otherwise have. Now we, though, need to complete that journey and move our debt stack to a senior facility, and that is the next major, strategic thing for this company to achieve. We have until February next year where we have a guaranteed amount of interest that we have to pay our current holders as part of the financing we put in place. Through that time, we are refinanceable immediately. And so, that will be obviously something of key focus and importance to everyone. And we understand that, so we will work away. At a notional level, though, we're not overgeared. So we are 1.9 times or less net debt to EBITDA here. These businesses in private equity hands historically been 5 times leveraged businesses. Obviously we're a publicly listed industrial. We're not leaning on leverage in the story at all. We're looking to build a business, but the actual starting point is fine. It's simply just too expensive. So, with thanks to our current debt holders, we'll be looking to move through them in the next, few months out to February next year. Cash flow, we'll skip through. We've got short-term, I guess, we had a gap between operating cash flow and bottom line cash flow as we worked through some of the challenges in the ADT business and the challenge that were presented from buying a business integrated into another business's systems. As we've got control of the finances and the ERP systems and taken over the finance departments, which we fully have now, we got impacted a little bit. Working capital was worse, and management of working capital was worse until we could actually see that. We have had to take the Australian business through the 3G to 4G upgrade, which was a really substantial piece of work, which we have, typically not talked about until more recent times, which is, underlying everything we've done in the business, and we've done it bringing this business together. We've also managed probably the biggest operational project this business can have, probably will have again for some time, which is taking the entire customer base off their old 3G systems and replacing the communicators or what needs to be replaced, plant panels included, onto 4G, which has taken up, a vast amount of the effort and energy of this business day to day to do. It has also cost us on the capital front. We are nearly through that. Technically, June 30 was supposed to be the finish. Then Telstra's moved it to end of August, I think it is, end of September now. It will probably keep blowing out a little bit. It's a very scary thing for them to turn off their 3G network. Most of the life-saving devices in Australia sit on 3G networks, so it may well extend. We only have a few thousand customers left, and then we're done. But when that does happen, then the capex drops away fully, and we'll go to, as we've been saying, being a very, very cash generative business we're looking forward to. That being said, there is a cost still to come in the New Zealand business, which is moving their 3G platform through this year. They're a year behind Australia in the shutdown. New Zealand's 20% of our business, so it will impact cash flow still next year, but the scale is quite different in terms of what we will all see. So operating cash flow and EBITDA, will increasingly line up as we start to drive cash flow and collect some of the back book and our receivables that we unfortunately had move out a little bit. So I guess coming to sort of wrap up this stage, 2025, we're really looking to drive a reputation, if I was to be that blunt. We want to be the leader. We want to lead through service. There is nobody that we look at in this industry to say does it really, really well or is the leader. We have more demand than we can deal with, whether that's commercial, big, large companies saying, hey, if you have your own technicians and deliver the quality ADT used to deliver, which we are still doing today, we'll give you all of our work. In our resi business, we have more inbound leads than we actually have been dealing with, certainly as we've been going through the 3G transition in Australia. So what we've got to be actually most careful about is building our reputation and actually delivering to that in a business that's still not yet perfect. We bought a turnaround, we bought a do up, and we are still doing that under the hoods, but we're getting better and better and better, and we'll stay the course until we are the leader. In each of those markets, the leading integrator for corporate Australasia, I think that's a goal we're excited about. We want to be the leading monitoring operation. So for us, as it relates to monitoring, it's all about video. We want to highlight to people, whether you're in your house wondering why am I paying for a monitoring service through to a business, that our ability to connect to video, to be able to verify events and to look for problems, to use AI will be very valuable, and actually you would be happy to pay for that. Again, through to care where, we want to look after people, and we have a role and a very, very good service. And I can say that again as a full freight paying customer, as I am, where we can help keep more Australasian people as they get older in their houses for longer confidently. So look, I'll pause there. It's a fast, high overview, and I hope hope that was of interest and can get some good questions.
Thank you very much, Dennison. Really appreciate the presentation. It was very thorough. Now, so I've got a couple of questions that will start us off, and then we've got a couple of questions as well that have been submitted by participants. Again, if any further participants would like to submit questions, I'll ask them to Dennison. Now, just to start us off, you did briefly touch over your three-pronged approach, which you're using, for targeting further business expansion. Right, where do you realistically see intelligent monitoring seeing the greatest growth from in particular within the next couple of
Yeah,
realistically like next 3 years?
the area that I feel we have the best control over is commercial,
Okay.
because it's customer conversations
Yeah.
and who we're engaged with or know already, and then it's really just matching that up with a workforce that meets the quality to what they're looking for. So demand, I feel, and there are a lot of, to the extent there are a lot of good businesses in the space. I'm always a bit unfair. I talk on average, this industry is XYZ, but that underneath that average in each little market or area or even state, sometimes there are some really good businesses. And so, which may be opportunities for us. But I feel like we can influence that best. I should note, like, as a result of that, I guess, market and comment, people are your key asset, actually. So the quality to what you do and are known for, and then the access to people. And one of the things also about I guess, the mission that we are on, the way we are presenting that inside the market, and the quality of the work we are known for, and that increasing complexity. Like, we are increasingly solving more complex problems. That's really attractive place to work. And so we also, as much as I want to be the demand stop of choice, I also want to be the employer of choice, and we know of quality work. And I think, so for me, that feels something that's tangible, that we can control, that we can build organically, firstly, which is our priority. Like, I want a business that I don't have to do anything, by course of necessity.
Yeah, of course.
But then obviously, we'll supplement that where there are sensible things to do that can aid and speed that process up.
Okay, well, thank you for that one. Now, just obviously, you did briefly touch on your competitors in the industry. What realistically is intelligent monitoring's competitive advantage over the other competitors in the industry, and how are you guys going about maintaining that advantage moving forward?
So I think I'll say there's three things. So firstly, the national coverage. So means less if you're a residential house, means most if you're BHP.
Yeah.
And so, and that's the story I've told people is that a key moment for me prior to ADT, when ADT, see, JCI actually came to us in the end saying, hey, could you look at this? And they had bidders for ADT. They had 4 potential bidders for ADT, and said, we think you guys, and we'd got to know them, obviously. It wasn't just a out of the blue thing. We think you guys can action this. It happened at a time when we'd been going out as IMG into large-scale business. I remember very clearly, we'd been inside an ASX, formerly ASX 100 listed business, big distribution business, at the board level, and they had heard our story and what we were trying to do, and they said, great, can you do it all for us?
Yeah.
They just wanted the 5-minute high-level sign-off with a name, reputed name, bit like in the old days, probably a bit passé now, but a PwC tick-off or and I realized we couldn't. I was like, oh, we can do one DC. And they're like, well, we want you to do them all. So that national scale, quality delivery at national scale is really valuable and would be very hard to compete against for some customers, right? And customers will pay a premium for that. The second is our actual operating platform. So we have a platform in our non-ADT rooms at the moment. Our ADT rooms are on a different monitoring platform that allow us to add devices. So when people talk about IoT and IoT monitoring, we can do that in 2 of our 4 rooms, which is a huge advantage. Our big competitors, I don't believe, they can't match us in that.
Yeah.
Not today. Now that can change, but that's a hard change, and they don't show any desire to invest in these parts of their business. That allows us to unlock video. So, driving video and the understanding of the value that video monitoring or video services can bring, because it can lead to big cost savings, whether that's in productivity in a factory, watching workplace health and safety and stopping, excessive billing, making sure people are on site when they're supposed to be, through to not having guards and patrols called out in false alarms, which is the majority of alarms.
Yeah.
Is a huge advantage. And then the final one is actually being open to all of that. And so I'd like to think, I'll put it a different way. What advantage does Macquarie Bank have in finance? Like, I don't think they really have any. Anybody could start a financial firm with a license, and there's lots of barriers, but there's nothing to prohibit it. Yeah. Ultimately, thing, and this is what it interests me personally and why I like this job and am highly engaged in, is I want to try and put in place a culture after, 20 odd years of looking at businesses closely myself, a culture that can not just do well today, but endure. And so the key part about that is honesty.
Yeah.
Understanding the services you offer and whether you can do what you say you can do and deliver to it, and that changes over time. So I think an advantage will be nimbleness, is probably another way to say it, and actually
Of course.
staying with the industry through different technology cycles.
Well, thank you very much for that one. Now, obviously, you guys did earlier note that there's a fairly large volume of debt on the books at the moment. But just shifting perspective there, will there realistically be any need to raise further equity for the company in the next 12 months, especially to the open market?
I've always found it, maybe it's my humor, a little bit amusing, because I think, like we did the ADT deal, and people, there was an attitude. Look, to be frank, it's driven by liquidity, and it's almost like, well, we'd like you to raise equity because then we can actually get some shares, which I can tell you is not of any interest to me anyway, personally. But no, we haven't needed to raise equity at any stage since doing ADT. We have raised equity because we've had really value additive things to do.
Yeah.
Do we need to raise equity for the debt refinance? We don't. Like, the metrics are absolutely fine at 1.9 times net debt to EBITDA. Threat Protect, which was the RTO'd business I mentioned prior to Peter and my joining the board in 2020, it had senior secured debt from Macquarie Bank. It had $15 million at a covenant of 3.5 times net debt EBITDA, and I think it was 2016-17, fairly normal credit conditions at BBSW plus 4%. I don't believe the world is any different now than then. There's been COVID and a whole lot of stuff, but right now, if anything, the banks are looking for quality corporate exposures, and we'll see what that means. I don't want to overpromise on rate or anything like that. I want to be a little careful. I don't know is the reason, but I have had approaches myself from several of the big four banks inbound with no reaching out, expressing interest in being involved in a refinance when that should happen. So, it's something we do have to work through. We don't need to raise money for that, but it's a key moment for the business. That being said, I'm not running a business for a refinance, so we also won't say, well, to me, that's sort of part of the rhythm of the business now that we need to do whilst we continue on operationally to do the things we want to do.
Of course. Thank you for that update. Now, obviously, with AI really emerging in the tech sphere and their potential for, business innovations regarding AI and intelligent monitoring, where do you actually see AI slotting into the business to actually be able to reap the greatest benefits?
So the way I explain the opportunity, and I wish I could show you a picture of my wall here in my office. I've got a sensor alarm, and then under it, I've got a camera, which is from our residential kit, which my daughter installed in 20 minutes. We're in a house whilst watching TikTok, and she's 13. So the system that I have attached to that with fire, water leaks, cameras, and sensors, would be equivalent to multi-$1,000s of a kit that would have taken probably a couple of days to do wireless. But the reason I've mentioned that is what we are really talking about in AI in the space is, in the old days, you had a beam. And if the beam broke, an alarm, it would trigger, that was the event, and it would trigger an alarm, and we would respond. We didn't know what it was. Today, the way I explain it to people, and the way I'm a simple person, I've not come from this industry, but the way I think about it is that camera's a beam. It's just a beam that takes in everything. And so the transition that's really happened is now we have a picture on everything all the time, provided the camera's on. And then, so we now are in a world where we can ask the camera to look for things. So the question is, what do you want to look for? So when you engage with a customer now, the question becomes, what are your problems, and can we solve them? So it's a totally different world, and that's the world. As I say, this change that's happened now. AI, as soon as you get into, well, I really want to see whether there's any bananas on the floor of my workplace or not. We've actually tracked, but people carrying bananas going down Chapel Street as a trial from one of our offices at one point. You can do a lot of things, but the question is, what is that? So that's where AI really fits in. And because for us, the risk in our business of transitioning to more cameras and looking for things is you get much more false alarms. And that's a huge cost to us. So if the cameras are going off all the time and we're having to respond, that can be a killer. So we need increasingly good AI, to continue to look for things, and that's the journey that we're on. And we want to lead that. I think we are, and we want to really drive that forward. And Australia is very unprogressed in that market, in my opinion.
Okay. Yeah. Well, thank you very much for that one. That finishes off my questions. Now, we've got quite a few here from participants. We'll just start it off.
Okay.
Now, first of all, the anonymous attendee submits, thank you for taking questions. With the remaining Australian and New Zealand 3G to 4G transitions to be expensed and not capitalised, and that hardware mostly sold upfront now after transitioning from JCI's high CapEx revenue mode, should we deduct a small amount related to these factors from the financial year 2024 existing EBITDA of 40 million when forming expectations for financial year 2025?
Yeah, no, look, it's a good question. So the reason that the number was, if I step back, when we bought ADT, we made a comment that, so the prior owner used to subsidise their customers heavily, and they put them onto this contract called ADT Owned, which was effectively, a term contract, in fact, up to when the customer wanted to leave, whereby there was a subsidised alarm system, but they also, even though they probably didn't know it at the time, was subsidising the service work. And because of the nature of that contract, it meant that technically you had to capitalise any, changes that came through. The answer to the question is yes. That being said, we are running the business real time in a way whereby we don't expect that you'll see any need to vary. Like we view EBITDA as a good base for the business to look forward. Another way to say that is, we pointed out that pro forma EBITDA was, I think, around $39 million post the last acquisitions in the pack. That is a base to which we're happy to I guess start from in 25 to move forward. So there is a little bit of technical movement in those accounts, but there's nothing that will actually translate to something that will be really appear variable in the P&L. Where you will see it though is cash flow, and you'll see a much better cash flow year in 25 over 24. And I think that's really the key. I mean, we've been running the business for cash flow. I would note, a segue just back to the 3G. There have been lessons and I guess things we got wrong with hindsight, and we've probably got some things wrong full stop, but probably the hindsight one's the interesting one for me. That 3G, when we took over, we put the prices of everything up rapidly, like significantly, about 160% for a core security system on day one, and that included 3G. What we probably didn't actually account for properly, which is the offset in the P&L to this point about CapEx, is that we also tied up the operational business was much more tied up than we thought. And so like in the last quarter of this year, we tried to work out, we think 66% plus of the effort internally of the business, whether that's service coordinators or salespeople, was actually tied up in delivering 3G. And all that's doing is trying to hold on to a customer. So the cost was actually much higher than what even it appears. Okay. So when you move into 25, that cost effectively comes out, even though you've got this point about CapEx, and it sort of nets out. And so we're free to move forward. I'm not sure if I explained that well, but yeah.
No, it was. Thank you. Now, moving on, what is the net working capital like in the long term for the business? Positive, negative, how's it sitting?
It would be a little bit negative in that as we grow. It's very short cycle. So we have to hold inventory for 36 days. The reason I smile at the question is that it looks far worse now than it will look in a year's time. Okay. Like at the end of the day, the issue we've had through this transition from JCI was, and I'll be blunt with people, like the biggest single issue we had was in September last year, and you can look at this publicly. We've chosen not to make much about it, so hopefully this is a fairly close forum, but JCI had a cyber attack, and we actually lost 2 weeks of billing in ADT. That went on top of our book. That we couldn't see, and we didn't see a closing statement or closing balance sheet. I didn't see that until really January this year. Before, it was the first time we got to see, oh crikey, that receivables is kicked up, and we've been collecting our run rate book happily. Like there's no technical issue around people paying or anything like that. There's been some really poor processes in the business, and including which we've remedied at the start of this month. Finally, we weren't billing for service work on the spot. We had a very archaic process around sending people out to service alarms, not being billed at the time, then going through a whole thing. And we were very, very hard to pay. And so most of the customer criticism of ADT, if you find it anywhere, there might be a general comment of negativity. It's not great. We've got a positive net promoter score, but you're always going to have a few people you're not doing the job for. So usually it's payment. Like we've been trying to pay you. You're actually debt collecting me, and I've been calling you, and you've not been taking payment. So these are process things that were improved. So I won't give you an exact answer. It's not very working capital intensive though. The cycles are quick. The inventory cycles are quite quick. We actually, COGS, it'll all be COGS moving forward outside of the care business, outside of 3G. So sort of to go back to that question before, CapEx, once we're out of New Zealand 3G, is simply stay in business CapEx, which I think is around $1 million a year, probably for a business the size, that type of number. And then we have our care business, which is about $2 million a year, which has growth and stay in business in it. And then there's actually will be no other CapEx to come through the business.
Okay, thank you for that one. Now, renegotiating the debt, can this be done earlier than Q1 of calendar year 2025?
Well, it's a little bit like that famous Kerry Packer comment to the Australian government. Like, if you want to tip the debt holders on the way out, you can do it because it's guaranteed. So we want to write them a check and say, thanks for coming, we're going a bit early. You could. I'm probably being cute about it because, I think anybody that looks at our group and character would say these guys probably aren't going to sit around and just wait for stuff to happen. That being said, there's very clear legal boundaries around it. And if you were the debt holders, why would you tip us on the way out too? Probably the other way. But look, we are, we're fairly savvy group, and we'll see if there are. But look, it may be that at the end of the day, we'll obviously announce it before that time, but it may well be that we have to wait to the end of February to actually get the debt to actually refinance. But it is front of mind, and it is something that we are working through.
Okay, well, thank you for that one. Now, just to refocus here, can you provide colour as to thinking behind allocating 10% equity via the recent raise to Alan Gray, despite having issues around the free float already, with obviously 50% of the company's equity tied up amongst two entities at this stage in the company's life cycle? Can you please help participants understand how this plays out with respect to shareholders?
No, look, it's a really good question. I'd probably just change the framing on it. So in that raise, one of the most notable thing in that raise was actually that Black Crane didn't participate. And that's the first time. So Black Crane, as would be noted, has actually been in the market buying shares, which was not helping liquidity. And so a direct conversation was had around that to say, well, it's not helpful, even though, and now you have to bear in mind that Black Crane has been privy through this journey to all conversations, whether that's people coming and talking to us about what they might think the value of our platform is, etc. So it has a very educated view on value, and what was not looking to sell stock and hasn't sold stock. The flip side is, so they're not taking up their pro forma 47%, also left a bit of a hole. The Alan Gray piece has been a number of years in the making. For them, it is, I want to be a little careful, but with their confidence, but it's an incredibly small holding for them.
Okay.
So and so even if we double or whatever we've done, it really doesn't move their returns much.
Yeah.
But they've done a number of years of work. They've followed Peter and I on other journeys. They've seen what we've done, and I guess know our character. Hopefully, and we've got to earn that every day. The journey that I've put forward to people, and I say to people here, is if we have the right capital markets support, I'm here because this is $1 billion business.
Yeah.
So it felt like the right time to bring on another, larger balance sheet of people that we know, to have good character as well, not be traders. And the one benefit I can say about having Alan Gray on is they're also not going to leak stock into the market
Of course.
at
Yeah.
any price. And so there are trade-off on all these things. We had, though, more demand and more institutional demand than we actually could handle in that raise. And there were some very difficult conversations, and that was a balance. Any less than that for Alan Gray would not have made it a viable position for them. So there was that they did not get what they wanted either, to be blunt.
Yeah. Okay.
But they didn't. So look, liquidity is a key and core problem in consideration. And, I guess we will, do our best to solve that over the time. Obviously, somebody like a Black Crane, there will be a price at some point, I'd imagine, where stock starts to become available. And for all shareholders, as you cross through from being a micro cap to a small cap, things do open up. So, I'm sorry if there's a lack of satisfaction around that. It's a balance. We've tried to be pretty fair and open, but also set the business for the medium and long term, so that we have the best shot we have to take this business through to its potential.
Okay, thank you very much. Now, just shifting here, to grow the adoption of the technology, is that a function of marketing / adding sales force to educate the market and increase awareness? With a slow consumer spending from a macro perspective, how do you realistically see this happening?
Yeah, so two different markets. In the consumer resi space, like we had 1,300 inbound leads last month, and we were busy on 3G, so please don't take this as indicative, but we put 170 new customers on, like nothing, right? We didn't meet our inbound demand. All we are doing is selling these systems it's a new system being sold into the market. And as I said, at some point, I think as people go through whatever issues that drive them to security products they ask their friends about and friends are on it, that will naturally drive an uptick. And we will invest behind that. So when we see that really start to uptick, we'll grow that. The reality is the base price of the system we're offering is less than an iPad. So, for most people, if I can tell you, and I also, not just the story with my mum, I've had my own experience about feeling insecure in my house. If you feel insecure in your house, and I say to you, for less than the value of an iPad, there is a decent sized market that will do that, even if times are a bit tough. So, understood. We're also going to bring in, now that we're on our own systems, we'll Afterpay this, and we'll try and make it an easier payment pathway for people to do. And I think that'll help.
Yep.
On the commercial side, different world again altogether. And so, yes, I think the challenge today is that there is actually so much that you can do. And this is a point I sort of make around IoT to people. Like, we can track and monitor, like, so many things. You can dream up lots of different value-adding little niches. The challenge is to actually make it commercial and commercialize. And so some of it is actually explaining to customers what's possible. And yes, you need people to do that. In reality, though, the core need for security products, we're in an interesting cycle with basic camera technology anyway. Like, there are a lot of cameras in Australia. CCTV market in Australia is the 6th biggest in the world. Sydney has the 6th most cameras per capita than any other market in the world outside of Sydney. It's just that they're all being linked back to a server and not back to base, or being monitored or looking for anything in particular. So as we transition through that, as camera technology changes, as cloud costs come down, there's sort of like a replacement cycle that's going to come through anyway. So I've probably done a bad job answering that, but yeah, look, it's a bit of both. Like, there's that natural demand. We have more demand coming at us than we can deal with at the minute. But there's also we need to fill that goal of mine to become the preeminent player. We do need to upskill our sales ability and what we are selling. And at the moment, security has been sold as a very basic, blunt product, when the reality is we're a technology company with a security focus, and that the minds that you need to sell it, explain that, articulate it are slightly different. And so we are on a journey there, I think, and it will require people and increasingly sophisticated people. Not that they're not today, but selling a slightly different service. So it's a bit of everything, I think. But security is not a GDP related product.
Yes. Yeah, it's a resistant marketplace. Now, regarding the Life 360 partnership, what's the revenue model from the 360 partnership looking like at the moment? And are there any other such deals on the table currently or in development?
Yep. So it's a unique model there. It's an event-based model. So when somebody has an event and when we have to call them, we get paid for that.
Okay.
We get paid well for that. So at the moment, it'll be a really interesting one. So for that room I mentioned in America, I mean, it's actually Life360 is their biggest single customer. And it's a big room. They have over 1 million, they have 1.5 million customers, and Life360 is their biggest by some way, and they're happiest. I think the same thing could and will happen here. So far, it has the numbers haven't surprised me, but they've surprised the team in the IMS. But where does that shape? It'll depend a bit on their uptake of the product. So it's an interesting journey. I mean, they're also, this comes back to the point of trying to sell to Australasians about the value of being monitored. Do people see it or not? Not everyone does. Until I got into this industry, I've never had a monitored alarm myself, wouldn't pay for it. Now it's about trying to create that value. So we'll see. But we're paid per event. It's not material at the moment, but it's positive and growing very quickly in that area. So it could become. Are there any other such deals? There is, I feel like, I don't know what it is. I mean, we've been on this journey with the new platform for 2 years. It has been slower than we would have liked 2 years ago, to be honest. Like, we've had the capabilities for some time, but the customers, being the dealers, this is more like a B2B business, have been slower. In the last 3 to 6 months, it's really started to pick up and the conversations are being had. We have a number of small new customers starting today. We have 2 this week that will bring in, a couple of hundred of customers themselves. It feels like it's picking up. Why is that? I don't know. I wonder whether being listed and having now, we now are actually increasingly recognised in the industry will drive that. We will see. The revenue models are all different though, but it's typically related to activity.
Okay. All right. Thank you for that one. Now, how is the inventory level now after a small initial substance delivery being sold out quickly? Are we supplied sufficiently for further demand?
Yeah, they're really good questions. So we've also had stop starts there. So the commercial business that we started, the residential business, very good pickup. We bought in CyberSense, and we didn't under order. We ordered everything we could given their pipeline at the time, and it sold out very quickly. And then we got caught with a hole, and then we got distracted and very focused on 3G. Yes, we have enough inventory today to start stepping it up, and now we're in that cycle of stepping it up as we step up. And so it's sort of, the ball's gone back to the sales guys now. As I said, like last month was not an exciting month because we had way more leads than we dealt with, and these are credentialed leads, these are qualified leads ready for a service. I think we'll start to get a better sense. I think the first 6 months of this financial year will be us starting to learn a rhythm and a cadence and start to answer that. But sitting here today, yeah, we don't have an inventory problem right now. We can sell. If you call up today and you want a CyberSense system, we'll get one to you in the next couple of days.
Oh, brilliant, brilliant. Now, just shifting back onto the acquisitions, why did the acquisitions take place at such low multiples, and essentially why the founders, of the companies that you just acquired, selling at the prices that they were currently selling at?
Yeah, it's a really good question. The first point I always make to people is like, don't assume that's easy. So it's not like, oh, people are rocking up to do these sort of deals. They were both existing customers in IMS. So as I said, like, we've got the sort, in a way, it's a bit of an advantage. Like, we deal with a lot of the industry through our business anyway. So they were known customers of IMS. One of them put their hand up and said, more of the elderly gentleman who was, ready to retire, had been in the industry his whole life. He, as he would say, had made good money. He was not in want necessarily of money per se, but he wanted to be treated fairly. For both of them, real answer is they wanted to go, their businesses and their staff who had supported them to have great lives, to go to a good owner. Okay. And so what they wanted to go was that their staff would go somewhere where the future was more exciting, or at least as exciting as it had been with them. Both of those businesses were really prototypical of what I talk about in this industry. One was based in WA and had no desire to leave WA. It had demand for work all around Australia. Its biggest customer was Services Australia, who wanted it to go to other states. And it was like, I don't want to do that. I'm not going to do that. No, thank you, but no thank you, and never did. We're already starting to take on work from another state in that contract, even since we've just acquired it.
Of course.
But was a very happy life. The other business was the same, bigger business, quite a lot bigger, but essentially four major customers, and didn't want to go much further. Was making very good money, really decent people. All the people involved here have been very decent, ethical, people. They just wanted to be with good ownership. Is that the case in every deal? No, there's a whole range of people out there, but it reflects a bit on both sides. We'll be very careful around what we pay, but we do think that opportunity, exists to continue to do deals at those sort of multiples over time. Should we find the right situations.
Okay, well, thank you very much for that one. Now, just continuing on the topic of the acquisitions, 5 or 6 years ago, a raft of acquisitions got the company into fairly large trouble. Essentially, this looks like another roll-up. What's different to this time compared to 5 or 6 years ago?
Well, I think so. 5, 6 years ago was pre-Peter and I joining, and they had our observation, and I want to be fair too, right? Like, people do lots of things for different reasons, but my observation was they'd actually moved so fast they hadn't integrated anything. So when I joined the board, there were 5 control rooms operating on 5 platforms, different platforms around the country, all subscale, in my opinion. And what I counted at the first board meeting, 3 COOs effectively, like a lot of people trying to hold the business together, and it wasn't really joining cash. And so, as I mentioned, for me, this is the single most important point around what matters to me, and that is, we don't want to get ourselves into a position where we overcook the business with so much stuff. How do we not do that? Well, we ground through a recapitalisation with lots of debt and no cash flow, with a shareholder, particularly Black Crane, but others who were prepared to invest in the business that didn't look that sensible at the time, to put in a platform that allows us to scale. And so the difference between what was then and what is now is this idea of a really centralized platform. Now, it isn't through our whole business with the ADT business. They run standalone, but it is in our core operating business. We're all on one ERP. And so I don't have a good answer. I mean, I guess that will be the thing we'll all look back on in this journey in due course and get to judge. All I can say is I'm highly attuned to that. And personally, that's, where I'll put my reputation on the block to say, we will absolutely do our best not to overcook and not move on until we're ready to move on. So, yeah, I'm not sure how better to answer that. But it's
I'm sure shareholders are going to appreciate that update. Just further on that topic, are there any plans currently that you could announce to the market regarding further inorganic growth?
No, look, I've been pretty open with people. Like, I have in my sight a couple of businesses that, should we wish to buy them and be in a position to buy them and have market support to buy them, which is also a key ingredient here. And so, it would have to be the right, we wouldn't be issuing shares for dilution or anything like that. We're looking to grow value through this whole journey. I can show you an Excel spreadsheet that shows with how in 3 steps I get to $100 million of EBITDA.
Yeah.
So, I make the very clear comment in everything I do, like, we're not here to be the world's best micro cap industrial. That being said, to the point of the last question, we're also not going to go and try and blow it up by just going so fast. So everything will happen at a pace. I'm very cognizant that we're coming off the back of things, and there is a heightened interest in what we're doing. The next strategic step for this company is to refinance. There may be little things along the way that come into the story that are strategic, but the next major piece of work is the refinance, and then we will judge as we're doing that the position of the business, the opportunities in front of us, and whether they make sense. One of my staff said to me, one of the guys in the team said to me about 6 months ago, anybody that thinks the chances are that this guy and this team do nothing in the next year, you'd be making a pretty poor bet.
Yeah.
I don't have anything to announce to you today, tomorrow, or in the next week or two that I'm really focused on. But I think it's a pretty astute observation.
I appreciate that update. Now, just shifting to ADT. Now, when ADT revenues were 125 million per annum, what kind of EBITDA margins did that really realistically present?
Yeah, it's about where it is here. So 25%. Yeah. I mean, it oscillated a little bit through the history, 20% to 30%. That's why I say like 25 feels like a good kind of number. So yeah, look, it's pretty stable. It largely, if you think about it, like service, installation, maintenance work is priced labor. So it's, you're basically charging labor plus. So that's a pretty set kind of margin. You determine that as long as you pass that through. And then operations is a large fixed cost kind of business, and you just have to make sure you're pricing those through. So, it's something. I'm not saying nothing. The danger of I've found in being an investor and an analyst myself, looking back at someone like myself, is you can imply precision that doesn't exist. Like, it's not like I can say it's 25%, it is, and then it becomes like there's a lot of moving pieces through the business, fixed cost, variable costs to get to that. But generally speaking, that dynamic's pretty sound. So, again, I'm not looking to ramp that margin up. We are in an investment phase. Like, we're still improving this business to the point about digestion and those sort of things. Like, we are investing in people, we are investing in what we do as we go. So, the rate of that investment depends a bit on the rate of improvement and growth. But a margin of around 25 drifting up over time is probably the way to think about it.
All right, thank you for the update there. Now, previously, the company has talked about capital management in 2025. Realistically, what do you envisage? And if a dividend is potentially on the table, what payout ratio would you approximately be looking at?
Yeah, look, it's an interesting one. We have not at the board level discussed a target yet, and I'm not abdicating. I'm happy to have a shoot the breeze on what it could be. I think the reality though is there's a wider complication, and that is we've got a lot of tax losses, so we haven't generated franking for some time, right? And so the reality is that probably steers. It will depend on where the share price is versus value, versus what the best mechanism is. So there is an unknown in it that, without trying to prevaricate and not answer the question, does make it impossible to sort of answer. But in reality, if you take my point about the free cash flow, you take my point about, not really, I mean, we will look to strategically de-gear, but, we don't need to go to zero either. Like, there's a sensible, healthy level of gearing that can be used in this business. You would expect quite a high payout ratio. I mean, for me, a 60% plus payout ratio would be imminently sensible, and achievable in a business like this. I mean, 60 to 80 even would be the kind of number on this kind of capital intensity you could expect. Again, it may be though that buybacks are the first cab off the rank, or a programmed buyback, a way of putting capital back might be more sensible initially.
Okay. Well, thank you for that clarification. Now, will monitoring on demand be a thing to help grow essentially the share of the wallet, right? Seeing how you're currently looking at less than 5% of the market.
Yeah, no, definitely. Like, it's that dream that I think everybody's in the industry's always had, but no one's had the technology to deliver it. We're not actively about to come out with a monitoring on demand product per se. That being said, in CyberSense, it's much easier to turn monitoring on and off. And so, like in the go forward product set, I think, yes, it will become that. I think there's real value to be got from that. I always say to people, if I travel for, call it 2 weeks on a holiday in Christmas, I will pay up to $300 to have my animals fed while I'm away, right? Would I pay $200 to have my house monitored 24 hours a day by a professional service company with a brand like ADT that can go straight to the police off an A1 graded control room, and very few people can? I probably could be convinced that that's actually pretty sensible, easy money. That's half a year of monitoring fees for us from an average customer or more. So, and I think the historic market, if we go back to all the people that have had monitoring and may not be monitored today, that would be one way of really picking up value. We're not yet at a point where we need to optimize that carefully. And so I think the best way I can articulate about where we're at as a business is this is like, especially that resi piece, it's like Foxtel Generation 1. At the moment, we're coming in and we'll probably offer you one sports channel and one movie package because that's where the market is, like in self-install Wi-Fi or whatever. As we grow and that penetration grows, I can foresee in 2-3 years' time, one, we'll bring in a lot more video services into your home. We will be able to verify if you wish us to. We'd only do it if you want us to. We will also be able to bring in like monitoring on demand. Like that's where this all goes. But today, when we're dealing with such low penetration with more demand than we can handle, we're not actively about to bring that in. But it's a really, really good point. Really.
Well, thank you for that one. Now, just the last question here today before we wrap everything up. After the initial 5 years, will IMB need to pay a substantial license fee to JCI? If the participant remembers appropriately, the right for royalty-free license was 5 years.
Yeah, I actually think it was 7 years if my memory's right,
Okay.
and it was but it's but happy to call it 5. I don't think that's the material point. We have a perpetual forever license. The way I explain what we have bought is we bought a franchise to McDonald's, right? So we get to use the brand like a McDonald's franchisee or regional franchisee would do. We get to use that brand forever, provided we don't bugger it up.
Yep.
And how could you bugger it up? Well, you could have an event that really globally, impacts the brand. It's actually funny to me a little bit because the question usually is that, which is, are you worried about, will you lose ADT? I'm actually more worried about someone else globally buggering up the brand for me that I don't control than I am worried about us losing the brand.
Of course.
And so part of the reason I wanted to bring Signature back into the stable, even though it looks a little bit funny, I mean, we can differentiate a bit between resi and a bit between, is I want to have a really strong, known second brand in the event, not that I lose ADT, but that I actually want to, move from ADT in a risk down event. So no, and look, in 7 years at the moment, there's a funny quirk of the deal we did is that JCI is actually paying what is pretty nominal money to maintain the brand for us in Australasia. And in 7 years, that drops away. We have to pay into a global pool to protect the brand. It's not material dollars. So that's the big change for us. Other than that, we can't go and sell. I can't sell burgers with the ADT name or cars or anything like that. Yeah. But I can do actually anything I want though in security and security related technical services. So I've got a really wide remit I can use that for, and we will. And they can't use the ADT brand for anything else in Australia. So they can't bring in an ADT fire or something like that around us.
Okay, well, understandable, and thank you very much for that update. Well, that about wraps everything up for us here today. So thank you very much, Intelligent Monitoring, for the opportunity, and then thank you very much, Dennison, for your time and expertise. This webinar has been recorded and will be posted up on YouTube. And Dennison, is there anything you'd like to finish us off with?
No, look, I just wanted to thank everyone for the opportunity. We really do don't take for granted support. It's very difficult to build a micro-cap company these days. We know we're only as good as our last hit song, as I tell everybody. So we're trying to build a good record and then hopefully a couple of records in a row. It's a focused team. I think there is a real opportunity, but it's going to take time. It's a compounding, situation. And I think it's a fairly, unique and sizable opportunity here if we can just, use discipline and exercise our powers every day. So I think everyone's for your interest and time, and we're fairly open. So if people, have questions, please feel free to reach out to Rod or myself, and we're happy to chat.
Well, again, thank you very much, Dennison, and thank you very much, ladies and gentlemen, for your time. Enjoy the rest of your day.
Thank you. Cheers.